Thanks for tuning into this conversation of the Alpha Strategist with Ashish Shanker Nitin Shanbhag. We do this monthly conversations with them, try and tie in some of the things that they've mentioned in the past notes to the current note. But of course, the focus and the starting point is on the current note. Gentlemen, thanks for taking the time out. So I will start off this conversation with a bit of a reference to the past as well. The August note mentioned optimism and arithmetic. The current note mentions against the odds. What explains this move from optimism and arithmetic to sounding a cautionary tale?
So hi Neeraj, always a pleasure to do this with you on a monthly basis. So I think optimism and arithmetic was more messaging on the fact that look, markets have run up. And since March, the broader market has also delivered and done extremely well, especially the mid-cap space as well as the small-cap space. So all that we wanted to message is that, any incremental investments into equity should be done with a clear view on valuations, on numbers, and not just get carried away on sentiment and the fact that everything is doing well. And because what tends to happen, Neeraj, is that during good times we tend to forget risk, right? And during bad times we tend to forget the opportunity. So our job as wealth advisors is to remind people of risk in extremely good times and to remind people of the opportunity in bad times. So that's why the messaging optimism and and arithmetic. This month we are trying to highlight that how much India stands out from the rest of the globe. I mean, if you look at the growth rates, right, developing nations are struggling at sub 2% growth rates. Even if you see world GDP growth expectations, it's closer to 3. India is actually the fastest growing, one of the fastest growing major nation in the world. In fact, we are growing faster than China. And it's not just GDP growth. Even if you look at corporate earnings growth, again, last quarter, we've beaten expectations. I mean, from an expectation of roughly 23%, we've done close to 25%. So in all sense, I think there is a lot of optimism, and that optimism is getting supported by fundamentals. So that's the broad messaging for this month when we say against the odds. And of course, G20 is the perfect backdrop, which kind of illustrates where we have come. And just to give you a small interesting statistic, we are doing G20 when we are $3.5 trillion. China at the same size did the Olympics. I don't know how many people know that. The Beijing Olympics happened when China was $3.5 trillion economy.
Okay, well, interesting. I didn't know this either. So thank you for that. But just pursuing, I saw the note peppered with references to what India is doing relative to China on the global growth contribution, so on and so forth. You cited not just GDP growth but earnings growth as well. 2 follow-up questions. Either of you can take them. One is, in the same note, you've highlighted the difference between stock market and economy and how people should look at it slightly differently. And in the last conversation, I remember that while Q1 started off well, you did cite that it's not necessary that the earnings growth would remain as robust for the rest of the quarters as Q1 has been, right? So how do you kind of square the circle in that sense?
Yeah, Nitin.
Sure. So first, to answer the question on stock market versus economy, right? Now, here is where certain key differences need to be brought about. One is that we all know financial services constitute nearly 35% of our heavyweight indices, which is essentially the Nifty or the Nifty 500. But as a contributor to the GDP, it's only about 5%, right? Similarly, agriculture is about 16% as part of our economy, doesn't have too much of representation in the stock market. Similarly, if you look at sectors like real estate or manufacturing or even logistics and communication, all these 3 sectors have anywhere between 15 to 16% representation as far as the economy is concerned, but hardly have too many players as far as the listed space is concerned. We may have some players coming up in the manufacturing side, but it's too small a number as of now. So the bottom line is that the trajectory of growth as far as the economy is concerned and the stock market can be very divergent, at least in the short term. We all know that over a period of time, maybe 5 to 10 years, they may converge. Yeah. But at least this is the standard phrase, which a lot of investors unfortunately mistake because they tend to look at the performance of businesses with performances of what is happening in the stock market. But that's a completely different universe altogether. Now coming to corporate earnings, just to carry on from the earlier statement that you made. This quarter we had about 32% growth on PAT, but largely led by two sectors. And these are going to be the two sectors which will drive the corporate earnings growth for FY24 as well, which is BFSI as well as auto. Right now, so you're not seeing really a very broad-based growth across the entire sector. Essentially what we are saying is that close to 2 lakh crores of bank profit in FY23 is going to grow to about 2.5 lakh crores, and about 29,000 crores of profits from auto is going to grow towards 54,000 crores for FY24. Effectively, all this put together, including various sectoral performances, will mean that the total Nifty PAT will grow from about 6.3 lakh crores to about 7.7 lakh crores, which is a good 20% number that we are estimating for FY24. Even if this number comes down, because as we progress into FY24, there could be a few sectors which may not do as well. One amongst them could be IT, because the global growth environment is not that conducive. Second could also be to do with some amount of consumers, because as we understand, rural economy is still to come out fully from the slowdown. Despite that, even if 20% were to come down slightly, you would have the fourth consecutive year of double-digit growth, which is not been seen ever in the Nifty.
Yeah, and sorry, please.
Just to correlate your other point, Neeraj, what has happened is, we had spoken about, earnings growth may not be as robust as the previous quarter. What has happened is the sectors which are doing well are doing really well. So the contribution from BFSI has actually exceeded expectations. Similarly, auto is also doing quite well. But a lot of the other sectors which are, which are slowing down, have not been able to impact the overall earnings growth, because the people who are doing well are doing extremely well. And BFSI is a very large contributor. And that also correlates with Nitin's point on the GDP growth. Even though GDP growth, because this is a question which a lot of people ask, Neeraj, in the shorter term, GDP growth is actually only 6%. How come, corporate earnings growth is growing at 15%?
Yeah.
So that was the connection that we wanted to bring out.
Yeah, no, and I'm glad we've done that in this answer as well. Ashish, just wondering, you are telling out rightly so that earnings growth possibility on BFSI is going to be strong. When you look at the relative valuations to MSCI averages as well, BFSI is actually lower. I mean, maybe lower than the average standard deviation as well, right? So why is it that there's no buying happening in those pockets?
Very interesting question, Neeraj. In fact, we discussed this at our IC this time around. See, look, often when valuations are a bit divergent, right? See, the fundamentals are good, profit growth is coming through, and but there's no buying coming in. You're right, and this sector in the last few months has been underperforming. Now, it could be one of two things, right? First is it is a value buy, and at some point in time, markets will adjust the prices, right? So it could be an opportunity. The second way to look at it, Neeraj, is that there is probably too much optimism on the sector at this point in time. I mean, the balance sheets are probably the best I have seen, probably in a decade or more than a decade. NIMs are extremely good. Things could not, I mean, yes, growth could be a little better, but otherwise, if you look at the recoveries for the PSU banks, for some of these corporate banks, which had a lot of NPAs, you've seen the best of the recovery cycle in the last 2 to 3 years, right? So the second point could be, is all the good news already factored, and incrementally, we could look at maybe NIM shrinking. So something that the market is telling you in the price, right? It could be one of the two things, and I suspect it could be a little more of the second part. because otherwise, the kind of growth we've seen in earnings, and frankly, some of these banks have re-rated also. See, PSU banks have done extremely well.
Yeah, but privates haven't, right? Privates
No,
have
but if you
de-rated
look at-
actually. If you look at it, Kotak or whatever it
but
is,
if you
they've
look at
come off.
Yeah, so ICICI Bank, if you look at ICICI, see, Kotak and HDFC never had the problems, right? They were always pristine in terms of balance sheet. But take the example of an ICICI Bank or an Axis Bank. They've been good performers, right? Some of the smaller banks which have kind of pivoted and doing extremely well, like an IDFC has done extremely well, right? So even within that private space, you just take the most interesting chart is HDFC versus ICICI Bank in the last 5-7 years. Right, HDFC Bank relatively is flat, and ICICI Bank has been a clear outlier, right? I remember ICICI Bank 5-6 years back at 270 odd. I mean, you're already close to $1,000, right? So it's done extremely well. So my point is that, in the privates, Kotak and HDFC have their own challenges, right? And maybe the market is telling us something. ICICI and Axis, etc., have performed extremely well. So have
Sure.
the PSU Bank. Now, what is incremental in store going forward? And plus, these are heavily owned sectors. Remember, I mean, like Nitin said, 35% of the index is made up of financials, right? So any index allocation comes straight into these sectors.
Just wondering,
incremental delta change.
Wondering, and either of you again, but a point that was made by somebody. Sorry, going off the note, but still asking. A point that was made by somebody was that. If one looks at flows that came in July, for example, the allocation was largely bottom up and not passive India flows, and which is why BFSI allocation was not that high, because it was not passive in nature. Once the passive flows come, presumably because of the India cynosure, India fanfare, then you might actually see BFSI do well. Could that be a possibility?
It could be a possibility because, see, at the end of the day, that is the largest sector to go with. But I would tend to agree that, a lot of it is already baked into performance. So if anyone is looking for too much of upside from a pure beta perspective, you may not get that. It's perhaps going to be far more stock specific going forward.
And Neeraj, just to add to that, that's a great point you make. See, when the allocation for the index comes in, banks will move in line with the remaining parts of the index, right? Because the allocation is coming to the entire index. So what is that delta buying that is going to cause that delta change in the index? Like, for example, last year in July, we had a big call on BFSI, right? We run a model mutual fund portfolio, and we actually added a banking fund last year in July. And last year to this year, it did extremely well, right? Because there was delta change in terms of buying. Even the actives came back to BFSI. But now going forward, what is the delta change you expect is the question that, we have to ask. So I think what is happening, Neeraj, clearly is, given the broad basing of earnings and the fact that the economy is doing much better than what we have seen in the previous decade, in terms of the spread of the companies doing well, I think this is a serious time for alpha. And if you look at even the mutual fund space, a lot of the active guys are actually performing index for a change.
Got it. Okay. Nitin, what does the temperature gauge index telling you right now? And I think in all of the notes, you've given a table of at various points of time, depending on when you initiate, but when the temperature gauge index is a particular thing, then the forward returns have been X, Y, or Z. So what is the current standing relative to what it would have been also?
Sure. So, currently the temperature gauge index is in the fair value zone. At this point of time, based on the last 20 years of analysis that we have done, if you invested into the Nifty, for example, the next 3-year returns would compound at about 8% CAGR, right? And we are obviously then expecting that the active managers would be able to add some bit of alpha on top of that. Having said that, a few nuances here. Now, on the large cap side, we do not see too much of a problem from a valuation standpoint. So is the case with small caps as well, because we've also done a little bit of analysis on the ratio of the small cap index relative to the large cap and the mid cap index relative to the large cap. So what we found is that from the previous peak, the small cap seems to be fine. But the mid caps have sort of run up far higher than the previous peak as well. So what we are really saying is that it's preferable to get into multi-cap or flexi-cap oriented strategies. And we continue to maintain the view of 50% lump sum and 50% staggered over the next 3 months or so. But when investing into select mid and small cap strategies, it would be preferable at this point of time to really stagger all the way over the next, let's say, 6 months or so.
Yeah, and I think you kind of mentioned this the last time as well, right, guys? That if people are putting in money, incremental capital to work, do it in a piecemeal basis, stagger it out, and so on and so forth. So that strategy continues. But it's interesting that your analysis seems to suggest that mid caps have actually done in terms of performance, a lot better than small caps, or conversely, might be slightly more riskier than small caps. Would that be a fair assessment currently?
Yes.
Actually, yes, because see, what has also happened is that the mid cap is confined to 150 names as defined in the SEBI categorization. So pretty much all the flows that are going into that space is only into this universe.
Yeah.
So we do find that some bit of valuations has also been propped about that.
Got it. Ashish, what if yields in the US move higher? You in your note this time around, you maintained these points about how India is faring better on a lot of counts, so on and so forth on the economic front as well. Now my question is, what if yields in the US actually stay higher or move even higher from where they are right now? I was reading a note from JP Morgan today, who've taken off their bets from a capping of yields to maybe higher yields, taken off their long bets on the 5-year treasuries as well. And coupled with that, for India, the problem of oil, and what if oil were to move higher? Because India thus far is faring relatively better maybe than some of the other economies on the inflation front. But what if oil plays the spoil sport? What happens to equities? What happens to fixed income as a result of that?
Both very interesting questions. Again, these were topics which were hotly debated in our IC this month before the Alpha Strategist. Yields in the US obviously have moved higher, and we looked at the charts, and in fact we had invited a chartist to help us understand what the trend is, and are we looking at significantly higher yields, or are we looking at maybe some softening in the near future. In balance, the view was that yields may not head much higher from here. Maybe it comes off from here, and there could be a lot of events in the future which could make that happen, because right now, look, the US economy is also not in the best of shape, right? It's showing strength, but on the ground, anecdotal feedback, if you take, there are a lot of challenges on the ground. In fact, retail is facing a challenge. The property sector is beginning to face a challenge. Tech, obviously, is going through its own, changes. So my point is that, I don't believe that, and also, in the run up to an election year, right? Seldom has the Fed been very brave or too hawkish. So in balance, our view was that yields may not head higher. And secondly, even on commodities front, given where China is in terms of growth and the kind of challenges that we see, because China is like, the lead indicator for commodities. The kind of size they are at. Again, on both fronts, I think we concluded that it's not much of a worry from medium-term point of view. Although in the shorter term, both these have gone into territories which, are little worrying. Having said that, these things, Neeraj, you basically evolve. Now, today I'm saying, our view is that it will not head higher, and hence our base case of equities, fixed income in India, etc. holds. But tomorrow, if let's say yields head higher, and let's say oil moves into $110, $120 per barrel, you change your view, right?
Of course.
You look at data and change your view. But as of now, our base case is that we don't see it as a cause for a concern, and maybe it's just a kind of a false breakout, and it's kind of settles down.
Remember, viewers, both of these gentlemen would also agree in the saying that in God we trust, everybody else must bring data.
Correct.
Some people go on to say even God must bring data, but that's a different story altogether. But gentlemen, this was lovely talking to you. Thank you so much. Sorry we didn't get time to talk about the fixed income, the gold portfolio. Maybe we'll try and do that the next time. But when I read through the note, Correct me, I mean, maybe we have 60 seconds. Was there something that we have missed which is a change from what was there the last time? Nitin, very quickly, fixed income or gold?
Not really. We pretty much believe that the 3 to 5 year space, as far as fixed income is concerned, is the right spot for accrual, but also to go into multi-asset fixed income solutions, as well as look at some of these other strategies like private credit, REITs, InvITs, so on and so forth.
Okay. We'll carry on some of these conversations in the next show. But yeah, for this show, this was lovely. Thank you so much, both of you, for taking the time out and joining us today.
Thanks,
Thanks a
Neeraj.
lot.
Always a pleasure.
The pleasure is ours. Viewers, thanks for tuning in.